Let's break down mortgage rates, the numbers that tell the real story. In 1981, mortgage interest rates hit 18%. Today, they're hovering between 6.5% and 7%. This is as of October 2025. So, with just knowing that, you would think it'd be easier to buy a home today than it was versus then, right? Not so fast. High rates with low prices versus low rates with almost impossible prices. Which era actually allowed you to buy a home with a better opportunity? Let's dig into it. Let's talk about the 1980s interest rate crisis, specifically the early 80s. October 1981 pretty much holds a record that you never want to break again. Mortgage rates peaked at 18.63%. It's the highest weekly average ever recorded in interest rate history. The annual average for all of 1981 hit 16.63%. The year before that, in 1980, the average rate was 13.74%. And these weren't just temporary spikes. Interest rates stayed in nearly double digits almost all of the early 1980s, all the way up until 1984. So why were they so high? Inflation absolutely ripped apart the economy in the 1970s. Oil shock sent prices spiraling. The Federal Reserve under Paul Volcker raised interest rates aggressively to kill inflation. But to put it in medicine terms, the medicine worked, but it almost killed the patient entirely. An 18% mortgage rate sounds insane today, and it was brutal, I'm sure, for the people who owned homes during that time. But even with 18% interest rates, home prices stayed relatively low. The median home price in 1980 sat at $63,700. By 1981, it had climbed to $68,700. But even with high interest rate, that was it. It was still under $70,000. So now let's leave the early 1980s behind for a little bit and jump into 2025 and where we're at today. Mortgage rates are fluctuating between 6.4% and 7.2. Again, this is as of October 2025, and the actual average is about 6.79%. It's roughly one third the peak of the early 1980s. So with that being said, sounds like a dream to be down this low. But the biggest problem, you're not buying a $68,700 median priced house anymore. The median home price in 2025 so far has hit $416,900. That's about a 505% increase since 1981. Or it's over 6 times more expensive to get a median priced home today. The trade-off is home prices have skyrocketed, but interest rates are a third, so it should be easier, right? We're about 61% lower than 1981, so what's the big deal? The problem is from 1981 to today, home prices have absolutely catapulted in price over how quickly interest rates have fallen since that time. So I could throw a whole bunch of numbers at you, but let's just look at the monthly payment reality. That's what I'm going to call it. Let's just look at monthly payments. Let's start in 1981. You go to buy a median priced home, $68,700, and you're going to put 20% down. You're financing roughly $55,000, and at 18% interest, your monthly payment is going to be $831. That's principal and interest only. Is it painful? Yeah, it is, absolutely. But it's manageable for a lot of families in the early 1980s because the average annual household income during that time was $22,390. Now let's look at 2025. Let's go buy a $416,900 median priced home in America. Let's also put 20% down. We're financing $333,000 roughly at 6.8% approximately. Monthly principal and interest only is going to be $2,165 at that point. Your payment's more than double the 1981 payment, but as to be expected because that was 40 plus years ago. So now we're like, what about inflation? Of course, inflation from 1981 to today, what's that look like? $831 adjusted for inflation actually comes out to be $2,900 in today's dollars. So in all reality, the inflation adjusted payment from 1981 to today is much worse. Around $2,900 with inflation adjustments, that's a lot more than the $2,165 payment that we're going to be experiencing with our median priced home today. So 2025 is the winner on that one, right? Not yet. Here's where everything starts to fall apart. We start looking at income. In 1981, the median household income hit $22,390. That $831 payment that we talked about represented about 45% of adjusted gross income. It was tight, but it was doable. In 2025, the median household income is sitting at $80,610. That $2,165 payment we mentioned at 6.8% represents about 32% of gross monthly income. So on the surface, all around, 2025 looks better. Lower percent of income going to housing. But this number is ignoring three massive problems. Problem one is the down payment. In 1981, 20% down on $68,900 meant saving $13,780. On a $22,390 median annual income, that's about 7 months of gross pay to get 20% down. Aggressive savers during this time could hit that mark in 12 to 18 months, which was achievable. You set a 2-year goal or a 2-year plan, and you hit your savings mark, you're buying a house with 20% down. In 2025, 20% down on $416,900 requires $83,380 to do so. On an average $80,610 annual income, that's over a full year of gross earnings, saving more than 100%. And obviously, nobody saves 100% of their income. It's just not possible. After taxes and living expenses, saving over $83,000 on average would take over 10 years. The barrier to entry in the housing market is significantly more difficult now than it was back then. Problem number two are the property taxes and the homeowner's insurance. In 1981, property taxes and homeowner's insurance on average added anywhere from $150 to $200 a month, depending on the area you lived in, combined for both of them. So with your $831 payment, with estimated taxes and insurance, you were $1,000 to $1,100, depending on your area. In 2025, property taxes and insurance average in the United States $500 to $800, depending on the area you live in. More expensive, less expensive. So at this point, when you adjust for inflation, the average cost of housing in 2025 is far more than it was in 1981. Problem number three is everything else costs more nowadays. Housing isn't the only expense that's exploded since the early 1980s. Healthcare costs have tripled. College tuition is up 180%. Childcare costs basically is a second mortgage payment. And car prices are up over 400%. The last piece, let's look at the qualification gap. So here's the kicker on this. In 1981, lenders looked at all of your income and all of your debt. If you made $22,000 a year and had minimal debts, you could qualify for a mortgage at a rate of 18%. Lending standards were extremely straightforward. In 2025, lenders are scrutinizing everything and people simply have more debt. So then that brings up the point of who could buy then versus now. In 1981, the typical home buyer was 24 to 31 years of age. Young couples at the time getting married were buying homes almost immediately. Teachers, factory workers, office clerks, grocery clerks, everyone was buying homes. There wasn't a specific group of people that was able to afford it. Everyone could afford it. Regular jobs at the time led to home ownership, which led to wealth building. In 2025, the average home buyer is 44 years old, nearly 2 decades older than the early 1980s. Home ownership has shifted from young adults to middle-aged professionals who have spent years and years saving to get to where they are. First-time home buyers today now represent 26% of all purchases in the home buying market, which is the lowest rate since 2014. In the 1980s, first-time home buyers made up over 61% of the buying market. So the bottom line is this: 18% interest rates in 1981 were insanely brutal. Nobody is romanticizing or fantasizing about those interest rates. But here's just the truth about it all. At 18% rates, you were borrowing $55,000. At 7% rates, you're borrowing over $333,000 if you can get the 20% to put down. So the math doesn't work in your favor. In 1981, you could save for a down payment in 12 to 18 months and still live a really good life. In 2025, unless you come from a wealthy family or have a nest egg set aside somewhere, it's going to take you 10 plus years to save for 20% down on a home. That's why in today's market, people are putting as little down as possible, 3.5% to 5%, and they're stretched too thin with their payments, and then they can never get ahead because they're putting down what they can for the dream of home ownership, but the payments hit. And then if rates drop, that's great, but home prices will explode and continue to climb higher because affordability is better, creating more demand, raising prices even quicker than before. The real crisis isn't the interest rate numbers. It's the complete disconnect between home prices and what people actually earn as far as monthly and annual income. In 1981, homeownership was painful, but it was possible. In 2025, for many Americans, it's not even a possibility.